Welcome back. You are watching Global Eye. Trump's tariff blitz has sent equity markets across the world in a tailspin. From US to Europe to Asia, investors are rattled as they try to grasp the magnitude of Trump's tariffs. Wall Street saw its worst day in 5 years on Thursday, a day after Trump's reciprocal tariff announcement. 7 large Nasdaq-listed tech giants, colloquially known as the Magnificent Seven, saw a market cap erosion of over $1 trillion. European markets tumbled on Thursday and Friday. These are fears across the continent that United States tariff strikes could push economies into a recession. The story in Asia has been no different. A report by Rosenberg highlights that Trump's tariff plan is destined to witness some speed bumps going forward. Rising trade tensions will put global supply chains at risk, and Treasury yields were seen declining as investors are seeking safety. How long will the tariffs continue to impact global markets, and will there be any reprieve going forward? To discuss that and more, we are joined by Bhawna, Chhabra, Senior Market Analyst at Rosenberg Research. Bhawna, thank you very much. Welcome to Global Eye. Now, it had been known for almost a month that these reciprocal tariffs are coming, but perhaps the extent has surprised some nations, including India as well. What do you think will be the impact on U.S. markets? If we start with U.S. markets, what's going to be the impact over the next few weeks? We saw a sharp reaction initially, but how will things pan out?
I think we have to look at it in the context of what the fundamentals of U.S. markets are and what lies ahead. So I'd like to highlight a few things here. When we're talking about trade uncertainty, global supply chains shifting, the first degree impact is trade contraction. When the trade contraction happens, earnings growth estimates they get trimmed down. When that happens, markets are bound to head lower. Then the second thing I want to think about is the multiplier effect. When the US market falls, you have wealth effect playing to consumer spending. The businesses cut hiring, they in fact fire people. Then you have people spending less. So that has a negative multiplier impact on the economy. The third thing I want to talk about here is DOGE-related cuts. So, the U.S. economy had been on this fiscal bump. We had so much spending coming in from the Biden government in terms of IRA, chips, and then before that, COVID-related support. That sort of helped the economy sail through despite one of the worst monetary tightening cycles we had seen since 1980s. So when we are coming off this kind of a situation, all these tailwinds that were there in the economy are sort of fading. And then we have an uncertain road ahead, which means trimming of earnings estimates. On top of that, the valuations, they are off the peak. So let's say I think the S&P 500 is down about 13% from the highs. NASDAQ has corrected by about 17% over there. But the valuations, they are like the S&P 500 12-month forward PE is at 20 times. Like if I were to look at last 20 years average, it's about 16 times. So now think about this. You have earning downgrades coming in, which are expected to happen in next few weeks, next few months. And then you have valuations, which is one standard deviation above the norm, a little less than that one standard deviation mark, but still high. I mean, this sounds unsustainable to us, and that's why we feel that there is more downside to come apart from what we have seen so far. Markets are not yet priced in for a trade war. We had seen trade bumps. This is like an all-out trade war. We saw retaliatory announcements from China this morning. We will see more. Like Europe is considering its response. So, I mean, it's bumpy road ahead, to put it simply.
All right, bumpy road ahead, further downside, and markets had not factored in a trade war to this extent. That's what you're saying. The impact on India, 26% tariff on India. India is not immune, but what would be your view on the Indian markets as of now? How would global investors be watching India amid this global uncertainty?
That's a good question, because India has been one of our most favorable calls over the past few years. Yes, there have been speed bumps in the road here as well. For example, like we saw this correction in the small and mid-cap space over here. There are two factors to this. One is the structural growth story of India, and one is the near-term story. So we do believe that there could be challenges in the near term, but markets had corrected even before the correction in the US markets began. So the valuation had come off the overstretched levels. Second thing to consider is, yes, 26% tariffs are high, but there are two factors here. One, India's dependence on goods exports is relatively lower when compared to the other countries we are talking about here, Bangladesh, China, Vietnam, etc. Then second factor over here is like I was talking about how the goods dependence is lower. The second factor is India depends on services exports a lot more. And then we had valuations come off the peak. When we're talking about those factors, and then I have to speak about very quickly about how the fiscal drain or strain on India has should sort of be in the backdrop now because we had seen government spending go down reasonably before the elections. That's sort of stabilizing. The RBI is expected to cut rates, so we look at it more favorably. But having said that, the negative news flow around pharma, etc., could keep it bumpy for some time ahead. But for somebody who can be a long-term investor in India, we advise buying on these dips.
All right, so buying on when it comes to India, but of course the tariffs in the pharma sector could be a big bump, and India is a major pharma exporter there. And Donald Trump has said that no one will be spared. Pharma tariffs are going to come like never before, like nobody imagined. He's even gone on to say that. Now, amid this all-out trade war with all nations, retaliatory tariffs coming in, what are the pockets of opportunity? Manufacturing, the auto sector definitely will be impacted. But who could be the gainers if the investors have to make the most of the current global situation? Which are the pockets of opportunity, according to you?
Okay, that's a good question. So let's start with global factors to start with. So starting with the US markets, I think what we expect is there is a flight to safety right now that's happening in the market. We expect that to continue. So we believe that the US treasuries would do well in this time because the yields will fall sharply. For example, the markets were pricing in 3 rate cuts from the Fed over the next 12 months. Now that's up to 5 rate cuts. So we do expect yields fall. There are inflation risks associated with the tariffs, but we believe the growth risk would trump inflation risk because inflation would not be really, really sticky in the near term over here, over the longer run over here. So treasuries is something we like. Gold is something we like. Yes, the gold had like climbed to lifetime highs, and it has sort of come down a little over the last 2 days. But we see secular tailwinds behind gold, and that's why it's one of our favorite calls. It remains one of our favorite calls. When I'm talking about US equities, we are recommending investors to go defensives. We really like utilities. We have recently upgraded consumer staples because of the defensive bent of the sector. We don't like consumer discretionary because of high tariff exposure of the sector. We also think that financials would survive this relatively unscathed in US because they are more domestically oriented. They are not so exposed to tariff. Yes, there are challenges to deal pipeline over there. Yes, there are challenges to asset risk redemptions. But to that tune, we believe it's a good idea to keep it neutral weighted to a mild overweight. Healthcare is an interesting sector in the US where we like service providers over the equipment manufacturers or pharma plays because of the very reason. So these are the things. Now, if I were to talk about India very quickly, since we are more of global macro house, so we look at it more top down. We believe financials would sort of tend to stand out in current situation because again in India it's domestically oriented. So this is how we are looking at it. RBI is set to cut rates. That's good for Indian bonds. So this is how we are looking at asset allocation. Be more risk off right now. Be in more defensive segments of the market till the time this uncertainty settles down, and then investors will have an opportunity to buy assets at better prices. That's how we are looking at the situation.
All right. One final question before we let you off, Bhawna. Donald Trump has said, I never go back on my announcements. So in a way, he's threatening the world that these tariffs are here to stay. Even though with trade deals with some countries, including India, there may be a halt to some of these tariffs, it seems that he would like to continue this harsh trading relationship or make trade, fair trade, a center point in global relations. Having said that, do you expect the uncertainty to settle down in 6 to 8 months and things will be normal after that? Or do you expect this uncertainty to continue for the rest of the Trump administration?
Actually, uncertainty is a hallmark of Trump administration. If we remember, Trump 1.0 was not very different. I think it's a bigger and a more louder what we saw in Trump 1.0. So we do expect the uncertainty to continue. In fact, when we released our outlook earlier this year, this was the central theme, the bog of uncertainty. So we expect it to stay. And I don't think the uncertainty ends there. One of the, like, few of the campaign promises that President Trump had was he wanted to talk about he wanted to go with deregulation in the financial sector and in healthcare sector and in many other sectors. He spoke about tax cuts, etc., etc. But US is staring at a huge debt figure over there. There's a debt ceiling issue. So there are multiple issues down the line. So even if the trade uncertainty settles for a bit, which we believe he's trying to use as a bargaining chip with some misguided information. For example, the tariff calculation. I mean, 26% tariff on India. India has an weighted average tariff on the US in single digits. So do many other countries. A few of them are 0%, like Australia. But Trump's administration still had tariffs on them because this is basically the trade balance with those countries divided by the total trade value. So he's basically punishing companies for having a trade surplus with the US. So his idea is if I eliminate this trade surplus, which he's reading as subsidies, it will all go away. But the problem is it comes with capital, like if I have to balance this equation of current account, if I have a trade surplus, like a trade deficit, I have a capital surplus. If I stop having this trade deficit, this capital will also flow out of the US. So we have to keep all these factors into consideration. So coming back to your question, I'm just listing out the kind of uncertainties we could see in the future. These are a few. So we really don't expect this uncertainty to go anytime soon.
All right. All right. Let's just hope that somewhere Trump understands that his policies are really hitting the US markets and are not good news for the global economy either. Thanks, Bhawna, for joining us. Let's move on and get